Hello everyone, my name is Jonathan Petty. In this video, I will be talking about the break-even analysis, a simple but crucial tool for operations management. In its most simple form, the break-even point is the point in units or dollars where total cost, which is our red line, are equal to total revenue, which is our blue line. This point is highlighted by a circle at the intersection of X units and Y dollars. The area under the revenue line and above the total cost line represents the profit corridor, emphasized by the green bracket. On the other side of this, we could see under the total cost line and above the revenue line is our loss corridor. This is emphasized by the orange bracket. For simplicity, we assume that all costs and revenues will act linearly within the relevant range. Each increases at a consistent rate with the amount of units produced. In practice, this isn't always the case. Increasing facility capacity will almost always lead to an increase in rent, which is a fixed cost. Allowing workers to enter into overtime will cause a nonlinear increase in expenses, which is a variable cost. Total cost is comprised of both fixed and variable costs. Fixed costs are incurred regardless if units are produced. Examples of fixed costs include rent for the facility, depreciation expense, yearly salaries paid to supervisors, etc. These costs are usually easily traceable to the direct cause, an example being the bill for rent every month. Variable costs, on the other hand, vary directly with the amount of units produced. The largest components are typically labor and direct materials, which are easily traced back to the project through timesheets and requisition forms. Variable overhead is also typically allocated to projects as indirect materials and other facility utilities that vary with production. The next component of the break-even analysis is the revenue function. It is typically a forecast of units sold multiplied by typical unit selling price. The contribution is selling price minus the variable costs. This is the money that contributes towards covering fixed costs until profit is reached, and then it is the amount of incremental profit earned by each unit sold. To find the break-even point in units, we take the total fixed costs and divide them by the difference in selling price and variable costs, otherwise known as the contribution margin. To find the break-even point in dollars, we first take our sales price per unit and subtract the variable cost, and then divide this by the selling price. This will leave us with our contribution margin ratio. We then take our fixed costs and divide them by the contribution margin ratio to yield break-even results in dollars. Remember that we use total variable costs when calculating break-even point, which include direct labor, direct materials, and any other relevant overhead. Once this basic formula is established, we could begin to modify variables. For example, we could observe the effects on break-even point of increasing our fixed costs. If we can increase the capacity of our facility and have to pay this much more in rent, we will have to sell this many more units or increase the price of our current units in order to cover the costs and begin turning a profit. When we analyze a firm that has multiple product offerings, we must take into account their sales mix, that is, the proportion of sales for each of their product lines. To do this, we must weigh each product's contribution in proportion to total sales of all products of the company's offering. We have our three products below: sheet metal, bolts, and carbon fiber. Each sell for a different price, each have their own costs associated with each, and each have their own demand. On the next slide, we'll work through a sales mix situation in order to find the break-even point. The first step to finding break-even point with multiple products is to divide specific variable costs by specific sales price. In this case, we'll be looking at sheet metal's variable cost of 50 cents and divide it by its sales price of $1.75. Which yields a ratio of 28.57%. Next, we will take the ratios we found and subtract them from 1, which yields us the inverse, which is also the contribution. In this case, that's 71.4%. Now we'll take the sale in units for the sheet metal and multiply it by the sales price to arrive at our total sales in dollars, which is $8,750. Follow this process for all of your others, and you'll finally arrive at the total forecasted sales of $21,750 in this example. We will then take sheet metal's $8,750 and divide it by the $21,750 in order to find our percentage of sales for sheet metal, which is 40.23 in this case. Then take this sales mix and multiply it by the contribution to find the weighted contribution. The sum of these numbers is the weighted average contribution margin ratio, which is 67.36 in this case. This number could then be used to conduct the break-even analysis. For this example, we will assume that our fixed costs for the period are $10,000. If we divide 10,000 by our weighted average contribution margin ratio of 67.36%, it would yield our break-even point as 14,846.42. We now know that we must make around $15,000 per period in revenue in order to break even. In this case, if our forecast of $21,750 is correct, then we have some flexibility. Our margin of safety would then be $21,750 minus our $14,846, or roughly $6,900. So to put this into some application, if we wanted to give the salesperson a raise of $1,000 for doing a good job, we could express this as our fixed cost increasing by $1,000 to a total of $11,000. We could then divide it by 67.36, which tells us that we must make revenue of $16,331 in order to break even now, after giving him the raise. Further application, we could use the percentage of sales from each specific product in order to determine how much of each we would be selling at our break-even point. If we took sheet metal's 40.23% and multiplied it by our fixed cost of $10,000, and then divided this number by our selling price of 1.75, we would arrive at 2,299 units. This tells us that at our break-even point, we're selling 2,299 units of sheet metal, which also lets us know that we must determine the exact number of workers and raw materials we need to produce at least this quantity, because this is our break-even point. Ultimately, the break-even formula is very flexible, which lends itself to many applications in the real world. Modifying the numerator reflects an increase in fixed costs or desired profit. Modifications to variable costs can also be done to reflect real-world situations such as fluctuation in supplier prices, which we're seeing now with COVID-19. It could help an operations manager determine their capacity, resources, and scheduling needs when used in conjunction with accurate information and forecasting. Thank you for watching my video, and if there are any questions, please reach out to me.